So hello, we can start with the next panel, which is on fintech lending. I'd like to welcome two representatives of fintech lending, but from the other side of the bridge. Virginia is from academic side, and Tymon is a practitioner. So fintech lending has developed in a very high pace in recent years. We went from paper applications and really lengthy processes to fully digital application and instant approvals, which is very convenient on one side, but brings certain risk on the other side for financial stability of households or for financial inclusion or instant credit risk assessment, etc. We will touch upon these points. So let me welcome our panelists. Virginia is assistant professor at Nova Business School in Portugal. She's focused on household finance and fintech, AI, and I don't know, probably you can specify more your areas. I don't remember them by heart. And Tymon is the founder of a fintech startup called
Loando Group.
Loando Group. You're present in 15 countries and 5 continents, which is impressive. So I guess you have lots of experience with scaling of fintech products to new countries. You have experience with regulation, different customer preferences, country specificities, etc. So I guess you can contribute into discussion from this practical point of view to complement academic research, which is working on. So we will start with the history overview, how fintech lending has developed in the past. And we can, let's say, start with some general overview. You, Virginia, what has happened, and then Tymon, you can probably say more country-specific views, what happened in each continent or country, and what are your experience with regulation obstacles or in spreading fintech innovations in various continents. So, Virginia, please.
Yeah, so thank you very much. So as you said, I'm an assistant professor of finance at the Nova Business School in Lisbon, and I mainly focus on researching household finance. My research is related to decisions of households in the context of borrowing, mostly mortgage borrowing. My research so far has not been focused on fintech lenders in particular, very traditional lenders, but of course technology now is adopted also by banks in their lending processes. So at some point, all lenders are going to become fintech lenders, I suppose. So in terms of maybe giving a definition of what fintech lending is, as far as I perceive it, is simply like the use of technology in providing lending products. And so this technology can be used either to improve customer, client-lender relationships, or in the way in which lenders screen and monitor their borrowers. So there are a lot of questions related to this. I guess in the mortgage context is more like on the use of technology in cutting processing costs and decreasing human interaction in this. And so from my perspective, fintech lending is very interesting to understand how technology can improve financial decision making, especially by less sophisticated households dealing with very complex financial products like mortgages can be.
And was the evolution in fintech lending, how can you compare past 10 years or 20 years? How technology helped really to make lending more convenient and faster?
Right. So my numbers are mostly from a review paper on the US. So I don't have many numbers about Europe. But so I think that one of the segments that grew the most is, where fintech grew the most is definitely the mortgage market, where I mean, even now, the proportion of fintech lender out of outstanding stock of mortgages is still very low, probably around 4%, but in new origination is more like 14, 15%, I would say. And then there was at the beginning, there's a marketplace lending with peer-to-peer platform, but that was not really a big success. And then another area that has been growing a lot is definitely the buy now, pay later segment. So that is has had a lot of adoption and raises a lot of questions regarding what does this mean for affordability of people that now
we will talk about BNPL later, but I just wanted some overview of the evolution. So Tymon, how did you perceive evolution of fintech lending over past years?
Yeah, so generally it's like went very rapid, and when we founded the company like 12 years ago, the digitalization of the process looks that we collect data of customer online, but send the agreement by courier, and it was signed by with the courier and sent back to us, and we gave it to the bank. Also, we need to collect all documents from the customer, so he need to download PDF file from the bank account history, send us through email, etc. Right now, everything is by one click. So he click, the log into the bank account, and thanks to the PSD2 and open banking, we collect all history of the bank account with all labeling, knows what is the income, what the spendings, what kind of spendings he has. Also, like the signature of the agreement is also online, so we can go through the process and generally can issue the loan fully online. Of course, it's like consumer loan. With the mortgage, it's a little harder because it's the mortgage there. Someone need to go there, check if it's real existing, etc. But still, depends on the market. We have like some governmental like portals when it can be checked, etc. So the process and the custom email of the customer and scoring of the customers, like it's fully online. And of course, depends on the market. It's like more like suites like that we can be used by the lenders and banks.
It's amazing that you do credit scoring based on transactions that you can access via open banking, but I guess this is a purely European matter. Is it available also in other continents?
Yeah, sure. For example, we have like big business in Brazil, and still like they're like Nubank. It's one of the rapid growing challenger bank on the world, and they also like right now have 40% of portfolio of the Brazil customers and do all credit process fully online in the mobile app. So the same we have in Mexico or Australia. So it's not only like Europe.
Let me ask the audience, have you ever applied for a loan online? Could you please raise your hand? What's the penetration of this technology in the audience? No one, you see, so...
I checked the processes,
you did.
I did it like many times, but yeah.
But do you think it's mainly for younger people, like Gen Z, who is willing to use this technology? And older people still prefer to the traditional way, go to bank and talk to someone?
Of course, like similar to the other process like e-commerce, etc. So like younger people prefer to doing so. Most of our customers in between like 30, 45 years. So generally younger, but it's available for everyone. It's only like to access and to want to go through the online process.
So let's now move to the risks of what this technology is bringing to the clients. It definitely influences customer behavior. Easier access to loans can create some financial risk to households, and it can also either increase financial inclusion or decrease and impose some discrimination. So how do you think, what are the risks in fintech lending when we relieve the decision on the algorithm and not on a human?
So of course, like it's many chances, like easier access to the financing, like better processes. We can like score customer better, like verify less frauds, etc. But the easier access, it's also like sometimes pressure for like mis-selling for that, like the people has like easier access to the finance than like the decision to take credit. Sometimes it's not overthinked, and it can be some kind of risk in my opinion. But generally, in all online process, I see much more like benefits than risks.
And what's the academic view on this risk that I mentioned?
So there are two ways in which technology can be used to screen and monitor your potential borrowers is either by using different data that banks usually don't use, or by using a different technology. So, for example, using machine learning algorithms to improve probabilities of default. Now, there is research that asks whether there is actually an improvement in predicting probability of default using this type of technology. So far, there are some papers that show that there is a little bit of improved predictability, but that soft information collected by banks through their long-term relationships with the clients are still have a bigger contribution in predicting probabilities of default. But this is all very interesting to understand what are the ways in which these online lenders try to screen potential borrowers.
Yeah, you mentioned this yesterday at our discussion, but I had an argument that if I can access bank transactions of the client and I don't know the client because it's a new client to me, I can gain the same kind of information as the bank where the client has been active, because I can see all the data that bank has access to. What is his consumer behavior, income. I can also access a credit registry. So I think the amount of information that is available via open banking is almost the same as the bank itself that where the client is active.
That's an empirical question, right? So, and there is also other type of soft information that a loan officer would collect by interacting with the person, speaking to the person.
Probably some interaction with customer service, etc. This is not available. Okay, you mentioned one interesting phenomenon that there are many households that do not refinance their debt even when the interest rates are going down. And this household could actually save lots of money, but they just don't do. This is what you observe in data. And do you have any explanation why is this happening?
Yeah, so it's a very widespread empirical fact that households tend to be very slow at responding to financial incentives, in this case, to refinance their mortgage when interest rates go down. Many households tend to continue paying an interest rate that is much larger than what would be currently available on the market. A lot of research has been devoted to trying to understand what are the frictions here. And so we're talking about unconstrained households that should be allowed to refinance their mortgage if they wanted to. So one is definitely lack of attention. People have limited attention, and maybe this is not top of their mind. So the question is, if you make information more available and easier to process, would this lead people into, refinancing more and refinancing better? And so here is where technology comes in. So I present a paper where I show the people don't refinance optimally. And so the question is immediately, why don't fintech lenders step in and nudge customers into refinancing? When is the time? This is a good question. I don't have an answer for this, but it's definitely something.
So now we can bridge our discussion to AI. How do you think AI can tackle this problem and help households to make better financial decisions?
When I think about AI in this context, I am thinking about financial advice. So there is a lot of research also on the relationship between financial advisors and clients and whether this also improves financial decisions. One stylist fact is that sometimes the households that seek for financial advice are exactly the household that needed the less. So it seems that more sophisticated households are the ones that are more likely to reach out to a financial advisor. Now with robo-advising and maybe artificial intelligence, people are going to have easier access to financial advice. And so this is another question. Will this help or will this not? Will people trust the machine to give good financial advice or not? Will artificial intelligence make it easier to digest this complex amount of information that people need to process in order to decide, should I lock my mortgage for 2 years, for 5 years? Should I refinance? Should I wait? I mean, these are not easy decisions to make.
Yes, there's a question of transparency, like AI is not really transparent, so when we ask for reasoning, sometimes it can hallucinate and we cannot fully rely on AI. But Tymon, I know that you use a lot AI in Loando, that's the pronunciation, Loando group. What is, how do you use AI? What's the highest added value of AI in your business?
Yeah, so generally, like, we have a few areas. First one, because we are the broker, so like marketing and sales is like one of the biggest part of our business, like to achieve the customers, like to show them product, to build the all funnel like in good user experience way. So general processing data, analyzing this data with channels, like how to convert, like what customer are doing, what kind of customer for what kind of product is looking for. It's help us like to collect this data, so we can collect by themselves, but then like to process this data, like to analyze and like to make conclusion in very fast, sometimes like in immediately way. It's not like few years ago that you need to collect data from like few months, send to the analytic, he will sit on that like 2-3 weeks, take conclusion, send you, then to IT, implement, etc. Right now it's a short script, which can like learn by themselves, so machine learning on or call it AI, and like make decision by ourselves. So we can exchange the offline agent or like the bank employee who take and who talk with the customers, process in the mind, and okay, this credit the best to you. Right now, the AI agent can do this like in 1 second. Second thing is also risk management. So when we have data about which customers like paying good, bad, etc., then we can like also recommend them some kind of product or unrecommend something, like if we know that he's like over debt or have like small chance like to pay back or can have a problem. So, and of course customer service, we don't need like 20-30 people on the call center to answer the phones, to explain customer how this works, what it can improve, or like how the process looks like. Right now, AI agent can even call customers or answer their phone and do everything. So it's much cheaper process. So less cost on the bank side, less cost on the broker side. So generally cheaper like cost of the credit for the customer.
So we mentioned several usages of AI. Do you use third-party solutions, or did you develop these solutions yourself? For example, virtual assistants that you use at customer service. Is it your own solution, or you bought it from the third party?
So generally, third party, like we are not so big company, like to write it by ourselves. Of course, so like we using like ChatGPT or other, and like try to generate our own agent, like based on their solutions and their environment and infrastructure. But yeah, so hybrid.
You also mentioned that you use AI for credit scoring. I guess it will be some kind of machine learning that you run on transactional data. How did you develop this model, or how did you create it, or how did you come up to this model?
Yeah, so generally we collect like data about customers from like the form that they filling, and like database that we are checking, like credit bureaus, etc. So we have set of data about customer, and then like have like decision the bank if they give the offer, and then also some information from the bank. It's default the credit or it's like paying goods. So generally like matching this data, we can find the conclusion and the area, the part of this data of customers determinate, for example, NPLs or default on such credits. Generally, like with the massive data that we have, like in all the world, in 15 countries, we proceed 2 million application per month. So with such data, of course, a different country has like different specific, but we can like put it and learn about, from that.
Mm-hmm. And I guess is it your own model that you are using, or is it third-party solution?
Our own
Your
model.
own, okay. I'm just thinking about challenges. You wanna say something?
Can I ask a question? Yeah. So, so how different is the type of data, the input data that you have depending on the country? So are there countries where you have massively better data and other countries where you have less? And so do you look at how does this, affect your screening?
Yes, so the data, of course, is like different in other country because, for example, not every country give the same database. For example, in Romania, we have like access to the like tax office information about like taxes that like customers paying, and it's very like important data for us because we know in other country we haven't. We have like credit bureaus in part of the countries. In others, it's in Mexico. It's not. We haven't access to such a database, and of course, it's like specific. But most the data is the same, like name, surname, incomes, like occupation, like education, marriage status, like number of kids, etc., etc. So part of the data are same and part of the data are different. So of course, like every country, we like consider as a different entity because it's also different credit institution, different politics, different regulation, etc. So like every model is like different for every country.
And I'd like to ask you what customers value most in fintech lending. Is it speed, transparency, easiness of user experience, or cost? What do you think is the most?
So generally, we concentrate on this like consumer lending. So it's like smaller tickets, smaller amounts. So time to money is most important for the customers. So they apply, and in 50 minutes they have like the money to spend. It's like, and sometimes this cost is not so important in this area because it's not mortgage for 30 years, high amount, and like half of like point like made a difference. Here, like if it's like 2,000 euro loan, like the 2-3% of ARR, it's not big difference. comparing to the process that in fintech you can do it like in 10 minutes. In the traditional bank you need to go to the branch, spend like 2 hours there, need to inform your employee that you are like taking the credits, need some documents from them, and it takes like 3-4 days. So sometimes the people don't care, don't want to have fast money right now, and it's, I think, most important.
So it's really becoming very convenient to apply for a loan. Virginia, is there any research done on how this easiness of getting loans impacts financial stability of households and vulnerability?
So not that I am aware of, but it's definitely a very interesting question. So as I said, there are a lot of frictions in lending markets, and one of them is definitely related to lack of time, lack of attention. People have a big mental burden of, comparing different offers from different lenders. And of course, if technology comes in and makes this comparison across banks much easier, I am very much wondering what is the impact then on the cost of borrowing for people. And I wonder whether this also has an impact on on competition and pricing of loans. So I'm not aware at the top of my head of research that has been done on this.
But there's still regulators trying to keep control over this lending, because of course it can become dangerous if a household take too much loan. So we are slowly running out of time. We didn't have any time to cover BNPL, but it's related to it. If a household can buy stuff without paying, it increases their financial vulnerability. So obviously, there's a trade-off between easiness versus money and financial health. How do you think that this fintech lending can expand to more complicated products such as mortgages or B2B lending? Tymon.
So generally, like B2B lending, I think it's already working like in the country that we are like working. So B2B it's much easier because the B2B lending is also not so regulated like the consumer, and the B2B business is not so protected as consumer. Mortgage, it's of course like still about the regulation in every country, but I see that it's also like pressure of the banks like to also digitalize the process, to save like money on the workforce, like to make also easier process for customers. So maybe not all process, but big part of process can be like digitalized. And so of course a lot of fintech which like help the traditional bank to implement some like signature of the agreement, like to make some kind of verification of email, like scoring, etc. Of course, part of the processes have to be still like offline because of like local regulations. But I think that the future it's also on side of fintechs and digitalization. So it's only a matter of the time when like the mortgage will be fully online.
I believe so. So we ran out of time. So let's conclude with the last sentence. What do you think are the biggest opportunity and biggest risk in fintech lending in coming years? So in 1 or 2 sentences.
Well, in terms of opportunities, mine is a research perspective. So for me, is the availability of information and the easiness or the ease of search and comparing products across the offers.
And the risks?
Well, and the risk, of course, is households not managing their liabilities properly and ending up with maybe too much debt.
Tymon?
Yeah, so also simplifying the process and easier access to the money and more pure processes, cost structure. It's like the chance, and the risk. I think that like protection of the customer, like to not like to give them many data, but like not too many, and to not use this data by the financial institution, like to upselling, cross-selling them in many ways, and also like to manage it with the national regulation and Europe regulation, and like other country regulation, to regulation keep on with the development of the product, new technologies, etc.
So to conclude, I still think that fintech is at its early stages. There are still many issues to be solved. Mainly, we have to find the right trade-off between the risk and the user experience or easiness to obtain credits, also transparency, inclusion, etc. So I'm very curious to see how fintech landscape will be developing in coming years. And maybe we meet here again next year or the year after with some new insights in this domain. Thank you very much for your contribution to the discussion. Thanks. And now it's lunchtime.